Stock Market Basics 5 Tips for Beginners. Hey guys, today we are going to list 5 tips for beginners in Stock Market Basics. Let's get right into it. Number 1, check your emotions at the door. Success in investing doesn't correlate with IQ. What you need is a temperament to control the urges that get other people into trouble in investing. Warren Buffett, chairman of Berkshire Hathaway and a frequently quoted investing sage and role model for investors seeking long-term market-beating, wealth-building returns, says so. Buffett is referring to investors who use their heads rather than their guts to make investment decisions. In fact, one of the most common ways investors harm their own portfolio returns is through trading over activity triggered by emotions. All of the stock market advice that follows can assist investors in developing the temperament required for long-term success. Number 2, select companies rather than ticker symbols. It's easy to forget that there's a real business behind the alphabet soup of stock quotes that crawls along the bottom of every CNBC broadcast. However, don't let stock picking become an esoteric concept. Remember that purchasing a share of a company's stock makes you a part owner of that company. As you screen potential business partners, you will come across an overwhelming amount of information. However, wearing a business buyer hat makes it easier to zero in on the right stuff. You want to know how this company operates, where it fits in the industry, who its competitors are, what its long-term prospects are, and whether it adds anything new to the portfolio of businesses you already own. Number 3, prepare for stressful situations in advance. Every investor is tempted at times to change their relationship status with their stocks. However, making decisions in the heat of the moment can result in the classic investing blunder, buying high and selling low. This is where journaling can help. Write down what makes each stock in your portfolio worthy of a commitment, as well as the circumstances that would justify a breakup, while your mind is clear. As an example, understand why you're purchasing. Describe what you like about the company and the opportunities you see for the future. What are your objectives? What metrics are most important to you? And what milestones will you use to assess the company's progress? List the potential pitfalls and indicate which ones would be the game changers and which would be temporary setbacks. Second, understand why you'd want to sell. There are times when splitting up makes sense. For this section of your journal, write an investing prenup that explains why you would sell the stock. We're not talking about stock price movement, especially not short term, but fundamental changes to the business that affect its ability to grow over the long term. Some examples: the company loses a major customer, the CEO's successor starts taking the business in a different direction, a major viable competitor emerges, or your investing thesis doesn't pan out after a reasonable period of time. Number 4, build up positions gradually. An investor's superpower is time, not timing. The most successful investors buy stocks because they expect to be rewarded over time, through share price appreciation, dividends, and so on. That means you can shop at your leisure. Here are 3 purchasing strategies that will help you reduce your exposure to price volatility. Dollar cost averaging is the first strategy for reducing your exposure to price volatility. This may appear complicated, but it is not. Dollar cost averaging is the practice of investing a fixed amount of money at regular intervals, such as once a week or once a month. That fixed amount buys more shares when the stock price falls and fewer shares when the stock price rises, but it evens out the average price you pay. Investors can set up an automated investing schedule with some online brokerage firms. The ability to buy in thirds is the second. Buying in thirds, like dollar cost averaging, helps you avoid the demoralizing experience of poor results right away. Divide the amount you want to invest by 3 and then, as the name suggests, buy shares at 3 different points. These can be done on a regular basis or in response to performance or company events. For example, you could buy shares before a product is released and put the next third of your money into it if it's a success, or put the rest of your money elsewhere if it's not. Last but not least is the ability to purchase the basket. Can't decide which company in a given industry will be a long-term victor? Purchase them all. Purchasing a portfolio of stocks relieves the pressure of selecting the one. Having a stake in all the players who pass muster in your analysis means you won't miss out if one of them takes off, and you can use the winnings to offset any losses. This strategy will assist you in determining which company is the one, allowing you to double down on your position if desired. Number 5, avoid excessive trading activity. Checking in on your stocks once a quarter, for example, when you receive quarterly reports is sufficient, but it's difficult not to keep an eye on the scoreboard at all times. This can lead to overreacting to short-term events, focusing on share price rather than company value, and feeling obligated to act when no action is required. When one of your stocks experiences a significant price change, determine what caused the event. Is your stock suffering as a result of the market's reaction to an unrelated event? Is there a change in the company's underlying business? Is it something that has a significant impact on your long-term outlook? Short-term noise is rarely relevant to how well a chosen company performs over time. What really matters is how investors react to the noise. That rational voice from calmer times, your investing journal, can serve as a guide to perseverance during the inevitable ups and downs of stock investing. That's all for today, and we'll be sure to catch you all in the next one.